Hello, and welcome to Stockseas. Today we will talk about one of the most well-known stock market indices in the world, the S&P 500. You may have heard its name in the news, articles, or financial discussions. The S&P 500 is an index of great importance, which includes large companies, operates in a specific way, and is closely followed by thousands of investors around the world. In this video, we will explain in simple terms what the S&P 500 is, when it has existed, which companies it includes, what were its best and worst years, and how you can invest in it even if you are a beginner. So let's get started and see together the world of the S&P 500 in an easy and understandable way for everyone. The S&P 500 is one of the most important and well-known stock market indices in the world. It was created to show the overall picture of the American stock market through the 500 largest and most powerful companies in the United States. We are not talking about a single stock, but about a large group of companies that operate as a single package. Within the S&P 500 are companies from many different sectors of the economy, such as technology, health, banking, energy, and consumer products. This means that the index does not depend on a single sector, but reflects the general state of the economy. If one sector is not doing well, another can compensate for it. The index acts as a thermometer of the American economy. When the S&P 500 rises, it usually shows that businesses are growing, profits are increasing, and there is confidence from investors. When it falls, it usually means there is uncertainty, fear, or economic hardship. A key feature of the S&P 500 is that it does not give all companies the same importance. Larger companies have a greater impact on the index's movement. For example, companies like Apple or Microsoft influence the S&P 500 much more than smaller companies that are also in the index. This is because the index is based on the size of the companies, not just their number. Simply put, the S&P 500 can be considered a mirror of American business activity. By following its course, one can get a general picture of how the United States economy is doing, and, by extension, the global economy to a large extent. The history of the S&P 500 begins in the mid-20th century, during a period when the American economy was in a phase of dynamic growth after World War II. In 1957, the Standard & Poor's Company created the S&P 500 with the aim of having an index that would more comprehensively reflect the course of the American stock market. Until then, there were indices with much fewer companies, which could not clearly show the overall picture of the economy. The S&P 500 stood out because it included 500 large companies from different sectors, offering for the first time a more realistic and representative picture of the market. Since its creation until today, the S&P 500 has gone through many historical periods. It has experienced economic recessions, stock market crises, wars, technological revolutions, and global events that affected the markets. However, the index has managed to survive, evolve, and adapt to the changing times. Over the decades, the companies in the S&P 500 have changed many times. Some of the great companies of the past have disappeared or lost their importance, while new companies, mainly from the technology sector, have taken their place. This makes the S&P 500 a living index, constantly updated to reflect the real economy of its time. Today, the S&P 500 is considered one of the most reliable and important indices in the world. Its long history, spanning over 65 years, allows investors to study the past and better understand how markets react to different conditions. For this reason, the S&P 500 is not just an index, but a piece of the economic history of the United States. The S&P 500 is not static. The companies in the index can change over time. If a company grows, becomes more important, and meets certain criteria, it can be included in the index. Conversely, if a company shrinks or faces serious problems, it can be excluded. Thus, the index is constantly updated and remains up to date. Finally, the price of the S&P 500 does not change randomly. It is influenced by many things, such as the financial results of companies, interest rates, inflation, central bank decisions, and major economic or geopolitical events. All of these factors affect the stocks, and by extension, the course of the index. In short, the S&P 500 functions as a living index that changes daily, following the course of the largest companies and reflecting the psychology and expectations of the market. The S&P 500 is home to some of the largest and most powerful companies in the world. These are businesses that affect our daily lives, even if we don't always realize it. Companies whose products and services are used by millions of people every day. The technology sector is particularly heavy on the index. There we find companies like Apple, Microsoft, Nvidia, Alphabet, which is Google's parent company, Amazon, and Meta. These companies have huge market capitalization and therefore influence the S&P 500 more than other smaller companies. But the S&P 500 is not just made up of technology companies. It also includes large banks and financial institutions, such as JP Morgan, healthcare and pharmaceutical companies, such as Johnson & Johnson, energy companies such as ExxonMobil, but also consumer and industrial companies such as Visa and Coca-Cola. What makes the S&P 500 unique is that it combines different sectors of the economy into a single index. So when one sector is struggling, another may be doing better. This balance provides more stability than investing in a single company or sector. Simply put, the S&P 500 can be thought of as a snapshot of the largest companies in the US economy. By tracking which companies are in the index and how they change over time, we can see how the economy is evolving and which sectors are becoming more important. Now, let's talk about returns. When we talk about the average annual return of the S&P 500, we are talking about how much the index has performed, on average, over many years. If we look at long periods of time, the S&P 500 has historically given an average return of about 10% per year. This percentage does not refer to a specific year, but is the average over decades. It is very important to understand that this return does not come in a constant way. The S&P 500 does not rise by 10% every year. There are years with big increases, years with small gains, but also years with significant drops. All of these years together create the average. For example, one year the index may rise by 25%, and the next year it may fall by 15%. However, in the long term, when someone looks at the course of the index over many years, they see that the overall trend is upward. This is why the S&P 500 is considered a long-term investment. The longer you stay invested, the more the fluctuations smooth out and the closer you get to the average historical return. Simply put, the average annual return of the S&P 500 shows us what the index has done in the past over time. It is not a promise for the future, but it helps us have realistic expectations and understand why patience plays such an important role in investing. In the history of the S&P 500, there have been years with very high returns when the index recorded impressive growth. These years usually came after difficult periods when the economy began to recover and investors regained their optimism. One of the best years in the history of the American market was 1933, when one of the predecessor indexes of Standard & Poor's recorded a growth of about +54%. At that time, the markets were recovering from the Great Depression, in a phase of strong economic recovery. Another excellent year was 1954, with a growth of about +52% in the predecessor index, shortly before the official S&P 500 was created in 1957. The American economy was in a growth phase after the Second World War, which was also strongly reflected in the stock markets. More recently, we have seen very good years like 1995, with an increase of approximately +134%, in a period when technology began to play an increasingly larger role in the economy. Similarly, in 2013, the S&P 500 rose about +32% after the 2008 crisis, as markets began to stabilize. Other strong years were 2019, with a rise of about +29%, and 2021, when the index recorded a rise of about +27% after the initial shock of the pandemic. What the S&P 500's best years show is that great returns often come after periods of fear and uncertainty. For this reason, those who remain invested for the long term are more likely to benefit from such strong bullish phases. Just as there are years of great upswings, there are also years of great downswings in the markets. These periods show how volatile the markets can become and why patience is so important for an investor. One of the worst years in the history of the US market was 1931, when one of the earlier Standard & Poor's indices fell about 47% during the Great Depression. 1974 was also a difficult year, with a fall of about 29% due to the oil crisis and the recession that followed. The index took about 3 to 4 years to return to its previous highs. The most famous recent crisis was in 2008, during the global financial crisis, when the index fell about 38%. The recovery came relatively quickly, and the S&P 500 returned to pre-crisis levels within about 5 years. 2020 was also a difficult year due to the COVID-19 pandemic, with a drop of about 34% in the first few months. The recovery was very rapid, as the index returned to its previous highs within about 6 to 7 months. Finally, after the dot-com bubble in 2002, the S&P 500 fell by about 23%, and it took about 3 to 4 years to return to pre-crisis levels. These years teach us that declines are a natural part of the market. The duration of the recovery can vary greatly, from a few months to decades, depending on the cause of the crisis. Investors who stay long-term and do not panic in difficult times are more likely to benefit from future bullish periods. From the best to the worst years, it seems that markets do not move in a linear fashion. There are sharp fluctuations, but the long-term trend is upward. Big drops may seem scary, but history shows that patience and long-term investing allow investors to benefit from future bull runs. In short, good years bring big returns. Bad years bring lessons in patience, and the recovery period shows how important it is to stay invested even in difficult times. Investing in the S&P 500 is much simpler than many people think. Most people don't buy the 500 companies that make up the index individually. That would be complicated and expensive. Instead, they use ETFs, which are exchange-traded funds that track the movement of the index. An ETF works like a large basket that contains all the stocks in the S&P 500 in the same proportion as the index. When the price of the companies rises or falls, the price of the ETF changes in the same way. This way, by buying a single ETF, you gain exposure to all the companies in the index at the same time. Some of the best-known ETFs for the S&P 500 are the SPY, VOO, and IVV in the United States. In Europe, there are similar ETFs such as the VUAA, CSPX, and VUSA, which also track the index. Each ETF has slight differences, mainly in costs and how they manage dividends. But they all follow the same basic goal, to outperform the S&P 500. Put simply, investing in an index like the S&P 500 through an ETF means you don't have to choose which companies to buy or when to sell them. The ETF does it for you, reducing the time, complexity, and risk of trying to build a similar portfolio yourself. Additionally, investing in ETFs allows you to benefit from the index's dispersion. Even if one company within the S&P 500 has problems and its price drops, the other companies can balance the loss, reducing the overall risk. Investing in S&P 500 ETFs is mainly suitable for those who think long-term and want to invest in a tool that tracks the largest companies in the United States. It is ideal for novice investors because you do not need to select individual stocks nor constantly monitor the markets. It is also suitable for those who want diversification without complexity. With a single ETF, you invest in 500 companies from different sectors, reducing the risk compared to investing in a few individual stocks. On the other hand, investing in the S&P 500 is not ideal for those who want quick profits, or for those who panic easily when the markets fall. Price fluctuations are normal, and full returns mainly occur over time after years of investment. In short, S&P 500 ETFs are a tool suited to investors who want safety through diversification, simplicity, and patience for long-term gains, without having to track each stock individually. The S&P 500 is not a magic button for wealth and does not guarantee profits every year. But it is one of the most powerful tools for those who want to invest with knowledge and patience. Its history shows that markets have ups and downs, with years of impressive profits but also difficult falls, and that patience and a long-term strategy make the difference. If you follow the course of the index over the decades, you see not only the peaks and valleys, but also the lessons that each crisis and each recovery teaches us. And the more you understand these movements, the more confident you feel about your investment decisions. The journey of the S&P 500 is full of stories of companies that have grown, crises that have been overcome, and opportunities that have emerged. If you want to understand more about the markets, see how the indices move, and learn practical ways to invest, it is worth continuing to follow such content and explore the tools at your disposal. In short, knowledge and patience are an investor's most powerful weapons, and the S&P 500 is one of the best teachers to develop them. The journey of investing is long, but each step offers experience, understanding, and over time, reward.